Be right back.
Okay, well, good afternoon, members and friends of our Family Business Learning community. I'm Sally Durstein, and I lead our team here at the Family Business Center. And I'd like to welcome you to our second program in 2021. It's PPP, Old and New, What a Borrower Should Do. And by now, we all know that PPP stands for Paycheck Protection Program. So thanks for joining us on such a beautiful day. And I'd like to begin by taking a minute to share just a high-level overview of 2021. As we all know, in 2020, we demonstrated a lot of resilience, emotional agility, and adaptability, both in our homes, in our personal lives, and in the workplace. And this year, in 2021, our theme is going to be about creating cultures of adaptability. And our theme book is going to be The Ideal Team Player. And it's authored by one of our favorite authors, Patrick Lencioni, when he describes the 3 key attributes of team players: humble, hungry, and smart. And these attributes really drive the highest levels of team accountability and performance. So this year, we're going to learn how our members are recruiting, selecting, and nurturing team members in each of their 5 mountains: the family, the shareholder, management, board, and advisors. And also how they're communicating and leading and adapting while navigating all these uncertainties. So I mentioned the mountains. We are privileged to work with many of you in helping with the governance around your mountains. And the mountains are teams and structures. And of course, it's complicated because many of you are in more than one mountain. You have more than one role. You're a family member, you're CEO, you may be also on the board, and you're a shareholder. Very, very complicated stuff. So today's topic, and actually before I get there, we are all about flourishing. I always like to say a word about our mission. We're about flourishing, not just in the business, but also in your individual lives and as a family. And this can be extra tricky in a family business. So I am grateful for our educational sponsors, our EDU sponsors, who help to contribute to our program in many ways, including with their experience and their expertise. And today we have Mario Vicari with us. Before I introduce Mario, just a few words about logistics. So if you have a question, which you will, this is an ongoing issue with the PPP program, Mario is going to be giving us a lot of information. So we're going to hold the questions till the end, but you are welcome to ask them at any point, but we will probably hold them till the end because Mary is going to be getting to a lot of stuff. If you'd like to, you just click the Q&A button at the bottom and ask your question that way. If you have a technical issue, go ahead and click on the chat at the bottom and you can ask a question that way. We will be sending out, if you're interested, the slides and also the recording, if you'd like to watch it or share it with others. So at this time, I'm going to introduce Mario. Mario, I've known for over 15 years. He is an accountant. He's a director of Kreischer Miller, but what makes him so special is he's just really a strategic thinker, always looking forward and really understands the 5 mountains. So we work together a lot. And I am eager to turn it over to you, Mario, to bring up your slides and to take us into the topic.
Thanks, Sally. Let's do this now and then just confirm when you can see my slides.
And by the way, while Mario is putting this up, he was on this. We had our first webinar last March already. So I think this is maybe your 3rd time presenting on some of these issues, Mario. Got it. So.
Okay. Well, everybody, it's good to be with you again on this ever changing topic. And yes, Sally, it's been, I don't remember how many we've done with you, but I've done, this program has changed all of last year, almost from the moment it got issued, it changed. There's a lot of, everybody remembers, I'm sure, a lot of stress about it and uncertainty about how to do it. Certainly the rules have gotten clearer as we've gone through, but they've changed rules in December and now again with the Economic Aid Act in December. So we're going to give you an update on a bunch of stuff about, we'll just say the PPP program in general, and also what are called second draw loan program, which is another round of it. So we're going to move through this. Brief disclaimer, I'm not going to read through it, but the one thing I would mention here is that particularly when you're looking at a second draw loan today, we're in a different environment than we were back in April of last year in terms of the lenders and everybody having good information, having portals set up. So lenders are far more capable now and more informed by the SBA about how these things work. So the lenders are kind of in charge of the communications with you. So I wouldn't hesitate to be, in communication with them about, your application and questions. And certainly I'm glad to answer them too. So we're going to talk about the legislative timeline. As I said, there's been a lot of changes. The loan necessity questionnaire is an important document for those of you that are going to go through loan review with loans above $2 million. And they recently issued some new guidance there. We're going to go over tax and accounting rules very briefly because we finally gotten some clarity there. And then we're going to go through the amendments to the Act, the PPP program, as well as the second draw loans, and if we have time for questions. So legislatively, a lot has happened. The December 9th was the FAQ 53. That was a response to the loan necessity questionnaire for the large loan review. December 27th, as we know, the president signed the Economic Aid Act. And the way that it works is laws get passed by Congress, the president signs them, and then the law, which in this case is the act, is then distributed to agencies of the government who have to issue regulations to implement the laws. And that began on January 6th with 2 rules on the Paycheck Protection Program, which they amended a bunch of things, and then the second draw loan program. So those came out in January. January 8th, new borrower application forms came out so that if you want to apply again, either for if you didn't borrow the first time or you want to do a second loan, those forms came out. And, there's procedural notices, and actually there's been more since January 13th. The one thing I would make sure that you all are aware of is that within the act, the law, they have stated that they are going to issue a consolidated rule on loan forgiveness and loan review, which is going to be pretty important. Many of you may have submitted your application for forgiveness already. Maybe you have not. They are going to be issuing a consolidated rule that brings in all of the stuff that was issued last year about loan forgiveness. So you want to pay attention to that. When we learn what that looks like, we send that out, and I always copy Sally so she can distribute it. So we're going to talk about the loan necessity questionnaire, otherwise known as the LNQ. So this is the form that's required to be completed for borrowers above $2 million. This was issued October 26th, and it was open to public comment until November 25th. Those of you who have to deal with this, I'm sure of the opinion that it's not a good form for the borrower. And so during this public comment period, the SBA received hundreds and hundreds of comments, including from us, about the problems with this form in terms of evaluating whether a borrower was eligible for this program. And that's what the loan necessity questionnaire is, whether the loan was necessary. So the report on that is that it was not changed because of all those public comments. They started issuing the form and using it almost right after the 25th. So the form is not going to change, but what we did get is some guidance in the form of a new frequently asked question, which we're going to go through. So just so you, to recap this form a little bit, the form has got a bunch of questions in it, but it basically is for borrowers above $2 million, and it's to make sure that the SBA believes that you are eligible for your loan. So there's questions in there that address this good faith certification requirement that says that borrowers are making the certification that they're eligible for the loan, taking into account their current business activity, meaning the effect of the pandemic on their business and their ability to access other sources of liquidity. So that's what this form is about. It has a bunch of questions, as you know. I think there's 8 questions in the first section on activity and 13 questions about access to liquidity. So the way that this form works is that it gets issued to you, again, only if you have a loan of 2 million or greater. When you submit your loan forgiveness application to the bank has 60 days to complete its review of that. Once it completes its review, it submits that form to the SBA. That is what's going to trigger the SBA to tell the SBA then is going to tell the bank to notify that you've got to complete form 3509, which is this necessity questionnaire. The important thing to note here is that if you're a borrower above 2 million, at the point that you receive notification from your bank, you're going to have 10 days to reply. So, and if you don't reply, failure to reply means that you're going to be losing your loan forgiveness. So you don't want to be unattentive to the timing of when this works. With most of the people I work with, and I've reviewed many of these forms already to help people prepare them, help them edit them. What you have to realize is my suggestion is you should have this form prepared. Again, if you're a more than $2 million borrower, you should have this loan prepared at the time that you submit your forgiveness application instead of starting from scratch under a 10-day gun to get it done. As I said, there's two sections to it: business activity and liquidity, 8 and 13 questions on the form. So the problem with this form, and I don't have snapshots of the form. Many of you that are dealing with it probably have read it, but the problem with the form and the reason for the many negative comments is that the CARES Act initially said that in order to qualify to be eligible for one of these loans, you had to demonstrate uncertainty at the time that you applied. That was really it. The language was uncertainty makes the loan request necessary. So a very broad standard. And so this form, though, doesn't even address uncertainty. Now, maybe the point of that is that they assume everybody had it, but it only addresses business activity and liquidity as outlined in a frequently asked question that they issued on April 23rd called FAQ 31. So the form itself asks for, so this ability to be eligible is a very subjective discussion in the CARES Act and many of the following regulations, even with access to liquidity and so forth. But the form gets very specific in asking very detailed information. And worse than that, it doesn't allow a place for the borrower to just state their case about why they felt the loan was necessary. There's only 6 questions in the form where the borrower can actually type responses, and each of them is limited to 1,000 characters, including spaces. It's not 1,000 words, it's 1,000 characters. So it's really unfair. It applies a lot of specific bright line tests against what we think is a very subjective standard. And what it also does is what I call Monday morning quarterback. It asks a lot of questions after the fact that gives them, it seems as though they're looking at things to determine, how was your business activity later, when at the time that you applied, you couldn't have known that. So there's a whole series of problems with this form. So the public responded. We didn't get a new form, but what we got was a new regulation in the form of FAQ 53. And there's 4 key points here that you should be aware of that are favorable to you as a borrower. Again, if you have to complete this form. First is the requirement to make it in good faith at the time of the loan application holds true. And they also state, even if subsequent developments resulted in the loan no longer being necessary. That is huge, because I think there's many borrowers who at the time that they applied, the standard was, are you uncertain? And then the way that this form conducts questions, it looks at subsequent revenues and stuff like that. And so it feels like they're looking for ways to disqualify the buyer if things turned out better than they could have ever known. So this frequently asked question is a big deal in the borrower's favor on this first point. It says that even if subsequent developments improve the business, it's still, the certification had to be based on what things existed at the time. So that's a win for the borrower. Number 2 here is the SBA takes into account the borrower's circumstances and actions both before and after. This is a mixed point. those of you who've seen this form know that it asks about whether you took profit distributions, whether you prepaid debt, whether you started new capital projects. Where they're going at, and also, how much you paid yourself. Where they're going at is, did you apply for this loan in April, and then sometime after that, before you got forgiveness, did you use large sums of money on other activities? Well, what they're telling you here in number 2 is that they're going to consider that. And I actually, the only thing that's unfair about it is it wasn't in the CARES Act, but it does make common sense, right? If you needed the funds to pay people, should you have taken a large distribution of profits? So that one's a mixed one. The next one's very important for you, the borrower. It basically says that if the SBA reviews this form, they don't necessarily have to make a decision based on it, because it's really, in my view, it's so narrow that they can ask for additional information, and you, the borrower, have the right to provide a narrative response. So you will get an opportunity, if they have questions about your form, that you can provide more information about your facts and circumstances and other details to state your case beyond 6 places where you can type 1,000 characters. And then lastly, they say they'll consider the totality of the borrower's circumstances. And I'm not really even sure what that means, to be honest with you. But anyway, this is what we got instead of a new form. Number 1 and number 3 here, I think, are very beneficial to the borrower, better than the form on its own. So at least some positive news there. So considerations when you complete this form: first of all, pay attention to the 10-day timing. And I would get it completed before I submit my loan forgiveness so that I wasn't under the gun to produce it, number 1. Be strategic in your comments. As I said, you only have 6 places on the form to write what you want to write. So use the space wisely. Pay attention to what the most important factors are to state your case, and know that you only have 1,000 characters. So abbreviate. I've reviewed and edited many of these already for clients, and I've become pretty good at abbreviating things, just to make so you can fit it all into 1,000 characters. And then lastly, the dates matter when you fill out when you state your case. And the important date is April 23rd, which is when they change these rules to make them more stringent about access to liquidity and other, affecting your business. Prior to that, the only standard in terms of making a good faith application was that you were uncertain. So if you received your money and started to spend it and made commitments to bring workers back prior to April 23rd, I think it would be favorable to your case to state that, and the fact that you already used the money, made commitments to rehire people before they changed the rules and liquidity or anything else mattered. You worked under a good faith interpretation of the CARES Act in the rules that existed at the time that you made the commitments to bring people back. I have one client that made an arrangement. That's a union company. They made an arrangement with the union when they learned that they received approval. They made an arrangement to bring back all of their workers because they didn't want to lose them, even though they didn't have revenues yet, to use this money to get them back into their jobs and to pay them to follow the program. And they did that days before these rules changed. So that's a very pertinent fact. And if that applies to you, I would use it in your application. Okay, we're going to talk very quickly about tax and accounting here. Taxes first. Those of you that have been paying attention to everything that's been written and discussed here know that taxation of these loans has been a topic of a lot of discussion last year. Basically, what happened was the CARES Act last March 26th, it was signed into law. It said that the proceeds from loan forgiveness of a PPP loan is not includable in your taxable income, so it's tax-free. Of course, a month and a half later, the IRS issued a ruling that said, yeah, the forgiveness proceeds are not taxable, but you can't deduct the expenses on your tax return, which for a taxpayer has the same effect. So the problem with that is that to give an example, if you're a taxpayer that got a $100,000 PPP loan, the instructions to use the money in order for it to be forgiven were not to get the $100,000, and in order to follow the rules, you had to spend $100,000 on certain allowable categories. It didn't say to spend $60,000 and keep $40,000 to pay taxes on it. It said spend $100,000. So the rules that they changed during the year left all the borrowers that followed the rules with having to pull 40% or whatever their tax rate was, have phantom income to the tune of 40%. Well, that all got put to rest. Finally, it took all year, a lot of lobbying by a lot of groups. And so finally in the Economic Aid Act, it became very clear that no amount will be included in gross income except for reason of loan forgiveness, and no deduction shall be denied. So there is no phantom income tax related to a PPP loan forgiveness. Not so fast with Pennsylvania though. Pennsylvania Department of Revenue has not issued a statement on this, but we have a state and local tax group in our firm that's all that they do is state and local taxes. They've been in touch with Harrisburg. And presently the position of the PA Department of Revenue is that they follow the book income treatment for the taxpayers, how it does its book income as opposed to its taxable income. So if you receive PPP loan forgiveness, the year that you take the forgiveness into income on your books, it's going to show up as income, but on your tax return, you're not going to recognize it because the federal government allows you to not count it. Pennsylvania is saying they're going to follow the book income treatment, which means that in the year that the loan forgiveness hits your books, right now, unless they issue other regulations, Pennsylvania is going to call it taxable in that year. So this is still very blurry. My advice here is to pay close attention to and talk to your tax advisor about how to handle your Pennsylvania tax. Under the presumption that most of the people on this call are probably S corps or some kind of pass-through entity, the good news is the Pennsylvania tax rate's 3% instead of the federal rates being much higher in the 30s. So it's still a cost though that you need to pay attention to because it's not uniform for Pennsylvania. Year-end accounting, just very quickly here. There's generally two approaches. The first is that you're going to treat the loan as debt. It's going to be on your balance sheet, and when the debt is legally released, which means you're going to get a letter from the SBA, that's the point that you write it off of your balance sheet and you record it as other income on your income statement. That is what 99% of borrowers are doing. I think banks like to see it. It's what most people do. It makes the most sense, and the idea here is that, look, a debt is a debt until it's not a debt. So until you know that you've gotten the paperwork that you've been forgiven this debt, you keep it on as a liability, and then you take it into income in the year that you learn that it's not a debt anymore. There's another approach here where the loan is treated more like a grant, and you're allowed to recognize forgiveness when conditions have been legally met or explicitly waived, meaning that you got the money and it's reasonable that you spent it the right way and you expect forgiveness. And so in cases where the conditions are met over time or in stages, you would recognize if you feel that you meet the requirements for forgiveness, you would take the loan into income over the same period of time that you recognize the costs. The trouble is that this is very subjective to determine, especially if you have a loan of more than $2 million, this is probably not going to work because you're never really going to, because no one knows yet how they're going to do these loan reviews. Even though we have people who've submitted the forms, we have not yet gotten anything back to know how they're going to actually do that. So 99% of borrowers are going to probably be in this first category. But again, whoever does your year-end accounting, you should be in touch with them to get advice. So now we're going to talk about changes to the Paycheck Protection Program, based on the economic changes to the Economic Aid Act. So the Economic Aid Act, as I said, was put into law on December 27th. And so, and they issued a regulation on this in January 6th. So before I get into some detail here, let's just talk about what they did. An IFR is a regulation. And basically what they did is they looked at, and Sally referred to earlier, like I was on a few webinars during last year as all this stuff was fluid and changing and, trying to figure out how to deal with it. They basically took all that stuff and consolidated it into one document and said, look, this is it. And then they also changed it. So these regulations in this SBA 2020-001 amend the overall Paycheck Protection Program. this deals with the program in an overall sense. Much of what existed that we went through last year is still there. In fact, most of it. They've tweaked it and consolidated it, but most of the original program still exists. So, and this is not the second draw loan program. This is amending the program in an overall sense. So the rule consolidates all of the interim final rules and important guidance related to borrower eligibility, lender eligibility, applications, origination documents, sort of start to finish. It consolidates all those things. So there were 21 IFRs issued last year that we tracked each one of them and sent out all these notices to everybody. This puts them all in one document. A lot of the frequently asked questions are consolidated into here. So this new rule is intended to govern new PPP loans made under the Economic Aid Act. So now, for those of you who did not participate in the PPP back in the first round, which there were 2 chances to do it, there was an original allocation of funds, and most people used that in the April and May timeframe. And then if you recall, there was another round of funds that extended the program into August. So if you're a borrower that for whatever reason didn't participate in that, you can participate in that again now. Like this is for first draw loans. So they're basically reopening the program there's more funding for it. So if you did not participate in the PPP initially, you can now participate in it as an original first draw borrower. Again, in the last bullet here, what's also important is that we are going to be seeing a consolidated rule governing all aspects of loan forgiveness, which I'll talk about in a little bit. So the point here, if there's anybody on the call at this point who has not, and I have one client who did not, and I'll give an example. A company that has more than 500 employees last year could not apply for this. Well, that 500 employee threshold still applies to a first draw loan. They went through a tough year and they reduced their head count of employees and they now have 400. Now they can go apply for this if it makes sense for them. So this is for anybody who didn't jump onto this, during the year. You can apply as a first draw borrower, today. So some details and some changes. I'm not going to go through how the whole program works. We've done that on prior webinars. Sally has probably a lot of those recorded. As I said, much of this program did not change, but I'm going to talk about the high spot of the way it works and then the areas that did change. If you want to participate as an initial first draw borrower, you have until March 31st to put an application in. Applications opened up at most lenders last Friday. So SBA started accepting applications last week. You still have to make a good faith certification that you're eligible for this loan. Just like I mentioned on that loan necessity questionnaire form, that uncertainty makes the loan request necessary, and that necessary is interpreted as the effect on your business activity and access to other forms of liquidity in a manner that wouldn't be harmful to your business. So you still, when you apply for it, you still have to make sure that even though you might meet the technical requirements with number of employees and those kinds of things, that you still are eligible because it's necessary. And so when you do this good faith certification of eligibility, it's as of the way things are today, not how they were last March. So when you look at your business today, you have to determine whether conditions as they exist today would warrant that this loan would be necessary for you. The covered period in the loan is still between 8 and 24 weeks, same as the original one. There was what was called an alternative covered period at one point last year. That is now gone from any of the law. There is no more alternative covered period. You either have 8 or 24 weeks or in between. The money must be spent in certain categories, and they've expanded the categories, which I'll talk about, but at least 60% of it still needs to be on payroll related costs. Payroll costs, by the way, include not just payroll, but it includes health insurance, certain employee taxes, not withholdings, but taxes like state unemployment, It also includes, I'm sorry, employer taxes, not employee. And it also includes retirement contributions. Those are all count as payroll costs, group benefits and so forth, which they even expanded those a little bit. The loan program is still subject to, you still got to go through loan forgiveness like you would have before. You still have to go through loan review if the loan's above $2 million. So if you borrow more than $2 million at this point, you got to expect that you're going to need to be dealing with that loan necessity questionnaire. The requirement in terms of headcount is no more than 500 still for this first draw loan program, or a relevant SBA size standard. If you're a large employer, there are certain cases where you can have more than 500 and qualify. And Code 72 businesses, which are restaurants, hospitality type places, you can have 500 employees per location. So, you know, if the business itself, that would be like a restaurant chain that has, different locations all over the place. You can have more than, the 500 rule doesn't apply to the aggregate, it's per location. The amount of the loan is 2.5 times your average payroll cost, same as last time. And the way that you do that is you look at your, prior 12 months, and I'll talk a little bit more about that. And you basically look at the number of employees you had, you look at what you paid them, you take a year's worth, you take an average, and then whatever that monthly average is, you multiply by 2.5. And that gives you the amount that you can borrow. Again, this is exactly the same as it was last year. And the maximum loan's 10 million. The only difference that they added for now, if you're going to borrow under a first draw loan now, you can use 2020 or 2019 or the last 12 months. That's what LTM stands for on my slide here, to calculate your payroll. Now, if you didn't borrow before, it's likely that you're going to want to use 2019, particularly if you had a rough year in 2020 due to layoffs and other reductions. You probably want to try to borrow the higher amount by using your 2019 payroll numbers, because they're likely to be higher since it was all pre-pandemic. So the changes that were made is what I'm going to talk about next. I'm trying to keep an eye on my time here. The changes are the calculation of the loan amount, eligible and ineligible borrowers. They've expanded the cost categories, and then they've allowed you to go back and modify your initial loan. So this is where those of you who already have a first draw loan, you might be able to change some stuff, and I'm going to go through that. So the new eligible borrowers specifically added in this round of changes. It's all of the borrower classes that were there before, including, independent contractors and small businesses, and all of the definitions that were in the initial act and some of the guidance. And these are now newly added. So 501c6 not-for-profits like chambers of commerce, and associations like that. Those are 501c6. Those are now available in the first round. It was 501c3 not-for-profits. So they've expanded that, which I think is good. Destination marketing organizations. I really don't know that definition. I'm sure it's in there somewhere, but you have to have fewer than 300 people. Housing cooperatives, news organizations, and nonprofit public broadcasters. So these are pretty, other than the 501c6, the other four are pretty narrowly defined. So they're now eligible than they wouldn't have been before. The list of ineligible borrowers got bigger. Some of these are going to be very arcane. I'm not going to cover every one of them, but you got to remember that if you were not in business on February 15th, 2020, you're not eligible for this first draw loan, really, or the second draw loan. Also, if your business has been closed at this point when you apply, you cannot apply now after the fact of closing your business. If your business is in bankruptcy, if you're a company that operates a facility that received what's called, this is part of the Economic Aid Act. There's something called a Shuttered Venue Operator Grant. That's a special program for people that operate conference centers and places where large gatherings are that obviously have been closed. There's a special grant program for those businesses. And so if you have received one of those, you can also get a PPP loan. So here's where I think they made some improvements. No more publicly traded companies, which I think is the right thing to do, because those companies have access to the credit markets, like public credit markets. And I can send anybody who cares to know the numbers, but if you look at what happened in the public credit markets between March and June of 2020, you'll see that publicly traded companies, because unlike many of the family businesses that are on here, we all know how hard it is to get access to money. Well, that's not the case for a public company. They issued billions of dollars of public bond offerings at low rates of return with 10-year maturities. So publicly traded companies have a much easier way to access liquidity than taking money out of this program. So they kind of said enough's enough and excluded them. And I think it is a good thing. And by the way, this is part of what created the uproar, if you recall, last April, when this got very political, when they learned that the Harvard Endowment and publicly traded companies and a lot of these places had received $10 million loans, and many of them, gave it back because they thought it was abusive. Now, to be fair, those people were just following the rules. The rules were pretty wide open, so they're narrowing the rules. Also, hedge funds and private equity firms cannot participate. Again, another good rule, because they have access to capital that they've raised. Lobbying organizations, household employers. If you're associated with China or foreign agents, not a good idea to get a PPP loan. And if you have the president or a member of Congress who owns more than 20% of your business, not a good idea. You're not going to get a loan. So a couple details. They've expanded how you can spend the money. Initially, it was on, as I said, payroll costs, which I gave you that definition earlier. But then you also have rent, utilities, certain interest payments. And there's a category of other expenses. Well, they've expanded that in 4 places, and I'll cover those quickly, but I have my time. So the covered operations expenses, it looks just like your sort of internal accounting, payroll, HR systems that you pay for. Payments for any business software or cloud computing service that facilitates business operations, product or service delivery, processing payment or tracking of payroll expenses, human resources, sales, billing functions. So basically the software, whether cloud or embedded in your system that you use to run the business, counts as something that you can count to use the money. Second new category, if you suffered property damage because of the riots that took place in the early part of the summer, those are allowable uses of PPP funds now. The third one is the big one, covered supplier costs. So these are expenditures made to a supplier of goods to the company that A, are essential to the operations of the borrower, and B, is made pursuant to a contract, order, or purchase order. So if you're a manufacturing company, this is like your cost of goods sold. Like, your suppliers are supplying you with materials under a purchase order where you issue a purchase order to buy things, or under a contract. So this is a large category of expenses that you can use the money for. This is arguably the larger of any of them besides payroll. So this is going to allow a lot more latitude to spend the money, again, on a first draw loan. And then the last category is something called covered worker protection expenditures, which is all the PPP, whether, the worker protection stuff, if you put plexiglass up, a drive-through window, anything to help your workers be safer because of the coronavirus. And there's a long list of really detailed stuff here, which I'm not going to go through, but I think you get the gist. If you spend money giving people things that help them be safe, or you alter your physical plant and so forth for that, that is an allowable spend of the money. They also expanded payroll costs. As I said, it originally said group health insurance, but they also included a new thing that adds group life, disability, vision, and dental plans to the definition of group health insurance programs. So, in this area, they've expanded, but remember that these other categories beyond payroll costs can only be 40% of the total spend. Payroll still has to be 60%. If there's anybody on here that got an economic injury disaster loan, you want to be talking to your bank. So these are special loans for some of the hardest hit businesses. And the way that the laws were written is back in last year that if you got an EIDL loan, and you went back and got a PPP loan, when you received you couldn't have both, was the way the law was written. And it repeals the new law of that we just got passed, repeals the CARES Act requirement to deduct idle loan amounts from loan forgiveness. So if you were somebody that got an idle loan last year, let's just say you got an idle loan of $200,000, and then you applied for $1 million PPP loan. When your PPP loan got funded, they subtracted 200,000 because you already got idle loan, so you only got 800. You can actually go back and reapply to get that money now. So you should be in touch with your banker. These things have not been made clear yet in terms of how you do it and the forms you use. But the important thing is the second bullet, that if you did get an idle loan and you got a PPP loan and the idle loan was deducted, they changed it and said, well, now they did it retroactively that you can have both. So you want to be in touch with your banker on that. Another thing you can do, so they changed a lot of rules here. And I've covered most of those changes. Depending on when you applied, they may affect you or not affect you. If you borrowed this money back in the latter part of August, you could still be in your covered period now. So these things are going to affect different borrowers differently. The important thing to note here is that you can modify your existing loan if you had one before. If these rules, as they've been expressed and changed, affected your loan that you got before, you can go back, and by the way, these forms are not issued yet, but you are going to be able to go back to your bank and reapply for your loan. So the following circumstances, if the guidance causes your loan amount to be different, you can go back and reapply and get the extra amount. If you already had a loan, if you look in bullet 2 here, if you returned all of your PPP loan for some reason, all these rules change and you got uncomfortable about whether you were eligible or not, and I do have people who sent the money back because they were afraid of getting in trouble because they kept threatening and changing these rules. If you're a borrower that got approved and you returned all the money, but you feel now that you were eligible, you can go back and get that loan today. So that's number one. Number two, if you returned part of a loan and you feel like, well, today that wouldn't apply to me, or I would not have done it that way had I known these new rules. Let's just say that you didn't think you had enough cost to cover all the forgivable expenses, and now these new categories let you have more money to spend. You can go back to them. If you've got $1 million loan and you paid back 200,000 prematurely because you know you didn't have enough expenses, but now you have enough expenses to spend the money, you can go back and get that extra 200,000 back. And then lastly, if you didn't accept the full loan amount, you can go request an increase. So if you've done any of these things, by the way, I have borrowers who had loans of more than $2 million who were trying to avoid the whole thing of loan review of loans above 2 million. So they paid back, let's just say they had $2.1 million, they paid back 200,000. So their loan was now 1.9, figuring that by doing that, they would avoid the loan review process. The loan review process is based on $2 million of the original loan amount, they don't count that you repaid it back. So if you're a borrower who paid back some of their loan in anticipation of thinking that it wouldn't get reviewed, you're getting reviewed anyway. So if you want to go back and get that 200 that you paid back, in my example, this allows you to do it. So anybody who has either not accepted the loan, repaid all of it or some of it, you have the ability to go back and get it based on the retroactive change of these rules. And you want to be very thoughtful about how you do that, and you want to get advice. By the way, again, repeat, forms not issued yet. You have until March 31st of 2021 to do this if you want to go back and get money. All right, so now we're going to finish with second draw loans. About 15 minutes left. I should be in good shape, Sally, in terms of timing. So the second draw loan program follows the rules of what I just went through in terms of the PPP overall, in terms of use of the money and all that, but it's a carve out of special rules for borrowers who already got an initial what's called a first draw PPP loan, if they want to come back and get another loan. There's a separate set of requirements for how it's calculated, how to apply, and how much you can get. So it's just for people who already did a loan already. So in order to be eligible for a second draw loan, you must have had an initial first draw loan, and you must have used the full amount of the loan for authorized purposes on or before the expected date of the disbursement of your second loan. So let's stop there. I have a client that got a first draw loan who repaid. They had 2.1 million and they repaid 200 to get down below that $2 million level. They would be precluded from applying for this until they reapplied to demonstrate that they used all of the first draw loan. In other words, the fact that they repaid that first draw loan portion of it down, they didn't use all of it. So they really need to go back and get the rest of that and demonstrate the use of it in order to be eligible for the second draw. So you have to have had a loan already, and you have to demonstrate that you used the loan for the authorized purposes, meaning, for payroll and so forth. You do not repeat. You do not have to have already received or even applied for loan forgiveness to be eligible for a second draw loan. You just have to be able to evidence the fact that you used it properly, used the first draw loan proceeds properly. There's some different classifications for second draws. The number of employees is 300 now, not 500. So 300 or less. And it's when you do the 300 employee count, it's not based on full-time equivalents. It's based on aggregate full and part-time employees. It's just a number for each person, full and part-time. If you're a restaurant, hotel, what's called an NAICS code 72 business, you can have 300 or less per location that you have restaurants or hotels. So there's a little bit more latitude there. It's based on head count, as I said, full or part-time. So the other thing you have to demonstrate in order to be able to be eligible for this loan is you have to demonstrate a 25% reduction in your gross receipts. That's the term of art. To me, it means your net revenues, and we'll talk about that in a minute. In one quarter in 2020 compared to the same calendar quarter in 2019. You don't get to choose, May, June, July, and August. You don't get to choose the 3 months. It's got to be a calendar quarter. You have to be able to demonstrate that you've had at least a 25% drop in your revenues one quarter versus the next between 2020 and 2019 in order to be eligible. Or you could demonstrate that you had that much of a reduction for the entire year. So you either can do it on a quarterly basis or for the whole year. You have to certify at the time that you receive this loan that you're going to have to sign a certification that said, I did use the first draw loan properly. And the affiliation rules apply to second draw, just like they did with the first draw loans if you're commonly owned by the same people that own the business. So calculating the loan amount for a second draw loan, it's pretty much the same. There's a couple nuances here. These loans are, just like I said earlier, how to calculate your payroll costs, 2.5 times your average monthly payroll costs. And for the most hard hit businesses, hotels, restaurants, which are code 72 businesses, the loan amount, you can use 3.5 times. So what are they saying? We're going to give you calculate your average payroll costs as defined. It's not just your payroll expenses, benefits and retirement and all those other categories I talked about. You take the average and we're going to give you a loan of 2.5 months of that. And if it's a 72 code business, you're going to get 3.5 months, a bigger loan, because those businesses were hurt the worst. One change that they're giving here with this program is that when you calculate your average monthly payroll, you can use either the 12-month period prior to when you apply for the second draw loan. You can use calendar 2020 or calendar 19 when you do that. So calendar 19 is, for most borrowers, is going to have a bigger payroll number because you had more employees. So you want to look at which one of these gives you the best answer to get the bigger loan. And just note, if you're a farmer or a rancher, there's some special rules about this that I'm not going to go into because they're pretty narrow. So one of the big places we're getting a lot of questions is, what does gross receipts mean? like, what does it mean for me? Is it on a cash basis? Is it, on my financial statements? Is it on my tax return? So they provided some guidance. And here I'm going to walk through it, is defined as all revenue in whatever form received or accrued. So they're saying, look, on a cash basis or an accrual basis, in accordance with the entity's accounting method. So however you do your accounting, if you're a cash basis taxpayer or accrual basis taxpayer, it should just be consistent with your normal way that you do your accounting. And consistency is what I would say is the key here. So it includes all sales of products or services, interest, dividends, royalties, rents, fees, commissions, and it's reduced by any returns or allowances, which to me means it's net revenues, because you get to reduce it by returns. It's not gross revenues. It doesn't include one-time capital gains, doesn't include tax refunds, doesn't include money from a foreign related company. It doesn't include fees collected by one travel agent, real estate agent, or advertising agent, where they take monies on behalf of a client, like you're just taking deposits on behalf of a client. That doesn't count. Most importantly is if you get a first draw PPP forgiveness or an idle loan forgiveness, those don't count as gross receipts for the purpose of this test. So they're talking about normal revenues in your business. And as I said, it is important to just stay consistent in how you do this. So documentation. For loans greater than 150, the documentation of revenue reduction is necessary when you submit the loan application. So if you're going to apply to this, you have to be able to document that you meet that 25 revenue reduction test when you make the application. If it's a loan for less than 150, you don't need to supply that documentation when you apply. You do need to supply it when you submit your forgiveness application. And then the other normal documentation for payroll costs and all that stuff still applies. Now, an important thing to note here is if you did a first round PPP loan and you use 2019 as your payroll, and you go back to the same bank to go for a second draw loan, you don't have to resubmit all your payroll stuff because they already have it. It says that you can already, if you're using the same bank and you're basing it on the same year's worth of payroll costs, you don't have to resubmit all that documentation a second time because your bank already has it. They already have a loan number open for you. You can just use that information that you already gave to them. So that'll save a lot of people a lot of hassle, and it's more likely than not that most people will use 2019 for their second draw loan. An important point to make here as I wrap things up, you have to remember that when you go for this second draw loan, you still have to be eligible for a PPP loan based on the facts and circumstances that exist today, not last year. Your good faith certification last year has nothing to do with whether you're eligible for the loan now. So if your business conditions have improved, you've got better access to cash, and you got to consider those things in from scratch to see whether you're eligible for this next draw loan program. So just because you met the requirements before doesn't mean that you're going to meet them now. You have to make a separate good faith analysis of whether your business activity whether there's uncertainty and whether your business activities have been affected and whether you have what kind of access to sources of liquidity today when you apply. And it's not a no-brainer that just because you got through it once, it's going to work again, particularly when it comes to loan review, which is what I'm going to cover in a minute. So pay attention. Most people they're focused on whether they have 300 employees and they've lost revenue by more than 25% in one quarter. You're going to have to sign that you certify in good faith that there's an economic need for this loan. And you're going to be checked on that. And I'll explain why I believe that's the case. So loan forgiveness and loan review, it's still the same. Covered periods 8 to 24 weeks. There's got to be a 60-40 split to be forgiven. The current law loan review safe harbor is $2 million. They have not yet issued regulations on the second draw loan program. So let me tell you what I believe is likely. If the safe harbor is $2 million on the first draw loans and the maximum loan on the second draw is $2 million, they're not going to likely allow everybody to submit a new loan application and not be subject to any review to make sure that they're doing it properly and they're applying in good faith. So they haven't come out and said this yet, but I'm pretty sure that when they issue the new regulations, they're not going to make a whole nother tranche of money available just because the cap is 2 million and say, well, we're not going to lower the bar on what we're going to review. So I fully expect that you're going to see a loan review process for loans below 2 million in your second round, second draw PPP loan. So all the more reason why I would want you to be really thoughtful about that good faith certification on the way in. Another question that we get is, what about stacking of loans? If I had one loan last year of $1.2 million and now I get another loan of $1.2 million, do they add them together to determine whether I'm over 2 million? They really haven't answered that question, but I have a feeling they're going to because everybody's asking it. My view is that that's unlikely. That's my own opinion, having looked at a zillion of these things. And the reason is that the facts and circumstances as to the certification for the first loan are going to be different than the other one, which is going to happen the better part of 10 months later. So I don't see how they could combine it until reviewing it as one, because the separate facts and circumstances are going to apply. I can't say that for sure. That's just my opinion as somebody who's spent hundreds and hundreds and hundreds of hours in the middle of this for the last year. And then lastly, if you have a loan of below 150K, there's going to be a simple loan forgiveness process for that. So I'm at the end, Sally, for Q&A. There's a few minutes left if you have some questions you want to ask.
Yeah, actually, there was a question that came in that's pretty specific and pretty complicated. So they're going to go ahead and email you directly, that's Mario. Fine. And I'd like to offer that to anyone else that's on this webinar. Mario is open to taking calls and questions. And so you can do that. You can send something to me. I can forward it. The information will be on the slides that you can access on our website as well as the recording. So I just want to really thank you, Mario, for presenting and for everyone being part of this. And I want to talk a little bit about our next event, which is in about a month away. In addition to these technical programs that we offer, we're also offering, as I said earlier, our theme is on cultures of accountability. And this year, I'm really excited that we're going to have one program on every mountain, where we're really going to focus on the mountain. And so the first one is the family mountain. And that's because that is the foundation, begins in the family, ends in the family. And the family is really where we develop the values and really the paths, if there are opportunities, into the other mountains. And what are the expectations? How are we going to nurture that growth? How are we going to create a stewardship mindset? So we're going to hear from Brittany Lukens-Heil from Laboratory Testing. She's a G3 Family Council Chair, shareholder, and she's also observes the board. And then we have Dwayne Berge, G3 Chief Relationship Officer, also shareholder and on the board. So they're going to be sharing their experiences over the years, and they've been doing a lot of good work. And we're hoping by that point, if we're not in person, which is a hope, but not a reality, that we're going to make this a little more live. If we do need to be virtual, we're going to be find ways to bring folks on and do breakouts and make it a little bit more interesting and personable. So thanks again for being part of this. Thank you, Mario. Always trust what Mario shares with us. As he said, he's put a lot of time and energy into this. So thank you very much.
Thanks. Good to be with you.
Stay well, everyone. Bye-bye.
Bye.